The JP Morgan Equity Premium Income ETF, known as Jeppy, has many dividend, more income-focused investors like myself concerned because of the last few recently announced dividend payouts. Month after month, Jeppy is announcing lower and lower dividends to investors, and it seems like even when the dividends cannot get any smaller, they just keep going down. Now in this video, we are going to give all Jeppy investors or potential Jeppy investors a thorough overview of what they need to know moving forward when it comes to this ETF, exactly why this ETF keeps paying less and less as of the last 6 months or so, and if or if not Jeppy is even worth investing into moving forward. Now, like I said, stay tuned because we are going to be going through all this and more. Right up to you, please drop a like on this video and subscribe for more future content like this. So first off, heading over to the JP Morgan website, it says JP Morgan Equity Premium Income ETF, or Jeppy. Now this ETF is rather simple. It's pretty much like any other covered call ETF. But as far as the overview, it says seeking consistent premium income with lower volatility. JP Morgan Equity Premium Income ETF seeks to deliver monthly distributable income and equity market exposure with less volatility. The portfolio managers with over 60 years of combined experience investing in equities and equity derivatives. The portfolio defensive equity portfolio employs a time-tested, bottom-up fundamental research process with stock selection based on our proprietary risk-adjusted stock rankings. And also the portfolio discipline option overlay implements written out of the money S&P 500 index call options to generate distributable monthly income. Now the results of this are supposed to be to provide an attractive 12-month rolling dividend yield of 11.45% or a 30-day SEC yield of around 9.59%. Which as of recently, it's even lower. Some last Jeppy facts before we dig a little bit deeper. And most importantly, the 30-day SEC yield is at around 7.7%. Now keep in mind, I currently own around 1,000 shares of Jeppy or more through my multiple portfolios. And when I started buying shares of Jeppy a few years back, this ETF was yielding around double. Now Jeppy is currently up around 1.87% year to date and is currently trading at the higher end of the 52-week range. This ETF's expense ratio is 0.35% and the dividend frequency is monthly. Now to get a little bit deeper into why the JP Morgan's distributions or dividends have been so small and consistently going down as of recently. Well, as we know, Jeppy does buy a basket of stocks and sells out of the money covered calls. Now according to Investopedia, a covered call is an option strategy in which a trader sells a call option while also owning the underlying security. Some key takeaways when it comes to covered calls. A covered call is a popular option strategy used to generate income in the form of option premium, which Jeppy does employ. Investors only expect a minor increase or decrease in the underlying stock price for the life of the option when they execute a covered call. So simply put, because Jeppy is selling covered calls and earning option premium, the option premium that Jeppy is receiving for selling the covered call is going to be less and less as the VIX or the volatility index trades lower and lower. And this is generally speaking because when the VIX or the volatility index is trading much higher, option contracts are generally going to be much more expensive to purchase. And in Jeppy's case, they're going to be much more expensive to sell, which means that when the VIX is at a higher point, in theory, option contracts are going to be also much more expensive, giving Jeppy, being the selling side of the option contract, the chance to earn much more premium in the fund and then of course distribute more premium for Jeppy investors like myself and like some of you. So year to date, as you see, the volatility index has been trading down and down and down because the market has been mostly bullish all year. So partially, one of the reasons on why Jeppy is likely paying less and less in dividends over the last few months is because the volatility index or the VIX is pretty much dead in the water, as you can see right here. So when it comes to Jeppy and the way the volatility index has traded over the past 5, 6, 7, or 8 months, you can see that there's likely a correlation because Jeppy's dividend payments have been lower and lower month after month, with the most recent dividend announced being only 29 cents per share. So for covered call investors that make some of their money off of the premium sold by the covered call fund, when volatility is at a near or all-time low, the option premiums are going to be much cheaper until volatility picks back up. So now, of course, you might be asking, where does this leave Jeppy investors from here? Because of the recent dividends paid from Jeppy and, of course, the underlying holdings that Jeppy has. That's exactly the reason on why I've been buying much more Jepq as of the start of this year. Now, if you're not familiar, Jepq has a very similar strategy of Jeppy, but because of the holdings breakdown being a majority technology, as you can see, when the market turns bullish and technology stocks move up, Jepq moves up as well, up 20.46% year to date, and that's not even dividends included. Where Jeppy, on the other hand, because the breakdowns are a little bit more defensive, you could say, is only up 1.85%, again, not dividends included, but still, Jepq has outperformed Jeppy like crazy year to date at least. least. Now don't get me wrong, because Jepq is so concentrated in technology, if technology turns for the worse and moves down drastically, the Jepq ETF's price will likely follow. But for me personally, either way goes without saying. As far as the covered call ETFs out there, I'm definitely buying a lot more Jepq than Jeppy moving forward. Let's actually head back over to the JP Morgan website and see a little bit more of what Jepq has to offer. It says that Jepq generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. This fund also seeks to deliver a significant portion of returns associated with the NASDAQ 100 index with less volatility. Now lastly, this fund constructs a long equity portfolio through proprietary data science-driven investment approach designed to drive the portfolio allocations while maximizing risk-adjusted expected returns. Now, what's kind of cool about this is they actually have the entire investment process laid out on the JP Morgan website. So in more detail, it says that applied data science processes utilizing 40 plus years of JP Morgan proprietary data to create a fundamental framework for security selection and portfolio construction. That's number one. That's the underlying equity portfolio portion of this entire investment strategy. Now with that, an option overlay. When it comes to options, 1 month out of the money call options designed to generate income and give investors a portion of the upside with reduced volatility. And with this, it equals Jepq, a well-represented, fundamentally driven NASDAQ 100 strategy that seeks to provide clients with a monthly distributable income via option premiums and dividends. So looking at the top holding breakdowns, Jepq has technology at almost 51% of the entire fund. Now in comparison, for example, Jeppy, Jepq's brother or sister, has only 17.34% of their entire breakdowns in technology. So you might be asking yourself, well, what's so special about technology and why does Jepq have so much of its overall holdings based in it? Well, the great thing about tech stocks in general is that they're known to potentially deliver significant growth. With technology advancements and innovations that are continuously going on, there is crazy opportunity in the market to make a lot of money and some major moves in the technology sector. Now, with the Jepq ETF being so heavily invested in technology, it is definitely going to have a much higher beta. Now, market beta, also known as systemic risk or equity beta, is a measure of a stock or portfolio's sensitivity to the overall market movements. So beta is a commonly used term as far as risk indicator. A beta of 1 indicates that the asset or portfolio tends to move in line with the overall market. If the market increases by 1%, the asset or portfolio is expected to also increase around 1%. Now, with Jepq's holdings being majority technology, that means that this ETF is going to have a much higher beta, again, compared to something like Jeppy. Now lastly, if we were to look year-to-date performance with dividends included and put Jepq next to Jeppy, next to QYLD, and next to the SPY, a lot of the most popular covered call ETFs, and of course S&P 500, with dividends included, Jepq has returned the most, with number 2 surprisingly enough being QYLD. The S&P 500 is behind that, and then Jeppy is far, far behind. So moving forward, if the volatility index does turn around and we do see some volatility, we can likely see some higher premiums for all the covered call ETFs, and hopefully see some nice big juicy dividends like we used to see a few years back. But until then, the best bet, at least in my opinion, is to at least own a covered call ETF that does have some potential for some capital appreciation, even if the dividends are not necessarily blowing me away. But I want to hear from you guys down below when it comes to Jeppy and all covered call ETFs. Are covered call ETFs still something you're adding into your more dividend income focused portfolio? And if so, what are your top 3 favorites? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks for stopping by, guys, and I'll see you in the next one.